What's going on, everybody? Welcome to Lunar Beaches Crypto, where we ride the waves of the crypto market all the way to the moon. This is video one of a free trading course where we're going to build a real understanding of how markets work step by step. We'll start with market structure, so that's what we'll be doing in this video. And then we will layer in tools like supply and demand, volume, VWAP, Fibonacci, all that good stuff. Some indicators, very minimal on the indicators, but we'll use those to help us build some confluence. And yeah, and that'll be it. So if this is something that you like, be sure to hit that like button and subscribe to the channel. Got to put that out there, even though it's kind of eh. But anyways, let's go ahead and get into it. So most new traders, they want to jump straight to interest, like it's a buy or a sell. But profitable traders ask a different question, which is who's in control right now? Who's in control of the market? And market structure helps you identify who's in control. So if you don't understand structure, everything else feels random and good tools. So first, we've got to point out, what do markets do? Markets expand and they pull back. They expand and they pull back. This is essentially it. This is what markets do. They expand, they pull back, and then you look for continuation of a trend. So when I'm looking for continuation of a trend, I'm looking for a swing level. This is called a swing level to get put in, and then for price to break that level. So if I get that break, I now know that I could be in an uptrend, especially if we get higher highs and higher lows continually, with not a lot of overlap between this pullback and this previous range right here. You can get a bounce off of the high here. That is when we are in a strong bullish uptrend. You get the pullback into the previous high, and then you get continuation. That's a flip of support and resistance, but that's not for this video. We're going to stick with market structure. Now, higher highs and higher lows, what do I mean by that? So we have highs here. We got a high here, a high here, a low here, a low here. So we're creating higher highs and higher lows. So when a market is creating higher highs and higher lows, you are in a bullish trend. You are moving to the upside. I personally, I don't count, and this is how I think everybody that does it right should do it. I don't count a swing level until that swing level is broken. So just because I put this low in here, that doesn't mean the low is a swing low until this high gets broken. Once this high gets broken, this becomes a swing low. Until then, everything in between can just bounce around. And then now we got a new low. And then we could see continuation off of that. But now, we see, if we get something like this on our price, which you will get a lot, you will get choppy markets, sideways markets. This is going to be our high, and this is going to be our low. These will be important coming up in future videos when we talk about demand and supply and that'll be our focus in the supply and demand video. I'm trying to keep these videos short and sweet, to not give you too much noise, to just try and give you the basics. We will do some more in-depth videos on these topics later on, but for now, I just wanted to get some stuff out and give you some of the basics. So right here, you can see just sideways chop. We're within a range. Nothing is happening until we break out. Then we look for a pullback. And if we get that pullback back onto this previous high, we look for continuation off of that level. So, important to note, just a slight break above and a pullback. This is going to be, I mean, technically it's a swing high, but you get a lot of overlap with this previous down move right here. So you kind of want to wait for a little bit more conviction in price before you consider entering on a trade, in my opinion. Now we can get a pullback to this high and then potentially get continuation. Conviction is basically what an impulsive move looks like. So with an impulse, so let's just pretend that this is a candle. Okay? And let's just say it looks like this. An impulsive move is going to be a bit more dramatic. You're going to have a much bigger candle on an impulsive move. So if it's just small candles, it's kind of just like not something that I really care about, not something that I'm really paying attention to. I start to pay attention when I get quick, big moves like this. These are going to be where you will have liquidity sitting in. So impulse and pullbacks. So big moves, pullbacks, big move, pullback, big move. And it's the same way up or down. If you're looking for the downside, you're in a downwards trend, right? So you create a low, you create a high, you create a lower low and a lower high. Odds are you're going to continue to the downside. You're in a downwards trend. Perfect example would be Bitcoin right here. In recent months, you can see we got the high here and the low here, and then the high here, and then our next low here. It's important to note, to remember that we don't create these levels until we break the previous low. Now we do get a little bit of overlap in this one, which is fine. But this was such a dramatic move that's kind of just like, you learn as you go. You get some you get some experience. You see what works and what doesn't. But the important thing to know is the change in the trend. So, and how to identify that change in the trend. So you can see that we were pushing to the upside. We come down. We push up here. This is actually going to be right here because this is higher. Push down, you push up, and then you come down and you break this swing low. Once you do that, then you start to look for potential pullback that leads to a down trend. And it's going to be the same way with a bullish reversal. you're going to look for the downtrend. This one's really crazy. And you tend to get really sloppy price action more so when you're moving to the downside. But this does not become a new trend until this high is broken, or potential new trend until this high is broken. And we don't break that until this move right here, which is very strong and impulsive. And then you get all the way up to the high before you get a pretty decent pullback. This is more consolidation, more rangy. This is big push down, okay? Another push up, big push down, one last push up to take out this high, and there you go. And now, on an even bigger scale, you are looking from this low to this high to this low to this high. So you can actually break down your market structure, top down, monthly, weekly, daily, 4-hour, 15-minute, all the way down. And you'll have your little waves inside of your big waves. Or moves, whatever you want to call them. Trends. But yeah, that's the gist of market structure and understanding market structure. Just remember, you've got to break previous highs and lows before you can get into a reversal of a new trend, the start of a new trend. And you don't get your swing levels until local highs and lows, local highs being most recent, local highs and lows are broken. When you get that, that's called a break of structure. And then you look for continuation to the upside. And there you go. We'll get into how to trade this in future videos. But for this video, that's going to be it. Thank you all for watching. I'll see you guys in the next video. Mad love. Peace out. Ride the waves. Bye.